What is going on, guys? Nick here, back with another video. GE stock price has been in a free fall for the past couple of years, but since the May low of about $5.50 per share, the share price has nearly doubled. Since the new CEO Larry Culp took over in 2018, his goal has been to turn around the struggling industrial giant. I thought I would take a look at what progress has been made so far and see if now might be a good time to get ahead of a big return. Taking a look back at the past 30 years, we can see that GE basically peaked around the same time as the tech bubble in the 2000s. Then, it sold off over the next couple of years, and we see a slow rebound until about $40 per share in 2007, and then another sharp sell-off during the 2008 recession. In February of 2009, it hit a low of $8 per share, 80% below the 2007 high. GE started to recover until 2017 when it saw the third major sell-off in the past 10 years. In 2017, GE was having pretty severe problems with their profit and sales. They cut all of their full-year profits and cash flow expectations to the low end of their forecasts. In his final earnings release, longtime CEO Jeff Immelt said that GE faced a slow growth and volatile environment in the quarter, and when you look at the history of its revenue and income up to this time, you can really start to see the decline. Jeff Immelt retired in August of 2017 and was replaced by John Flannery. Flannery's tenure didn't exactly last long. Flannery was pushed out after a year by the board of directors after not taking quick enough decisive action. The stock price had continued to fall under Flannery, and in all fairness, he was dealing with a pretty serious mess of a business. They announced the new CEO would be Larry Culp, who took over in October of 2018. Culp is the former CEO of the Danaher Corporation, which is a conglomerate that owns a bunch of medical technology, manufacturing, and scientific research tools. Under Culp, Danaher's share price grew by about 400%. And if we look at the revenue and net income for Danaher, we see a pretty successful looking business. Culp has two major goals for GE. In their 2018 letter to shareholders, he explained that the number one goal is to improve GE's financial position. He explained that they have way too much debt and they need to reduce it soon. They're selling assets to raise cash that they're using to buy out some of their outstanding debt. They sold off their biopharma business for $21 billion to Larry Culp's previous company, Danaher, and will continue selling their remaining 37% stake in Baker Hughes. The next goal is to improve their overall efficiency of their business. They want to basically improve the service to their customers and find ways to cut costs. The annual letter to shareholders highlights some of the examples where they found massive savings. What's really interesting is if you look at some of their profitability metrics, their return on capital percentage, which is their net income minus dividends, divided by the equity and debt, is finally starting to show improvement. Between 2010 to 2017, they were somewhere between -3% and 4%. And so far this year, they're already showing 7%. The balance sheet is also pretty interesting to say the least. When we look at its changes over time, we can see how much they've sold in assets. In 2016, they had $365 billion in assets, and most recently reported $245 billion in assets. They decreased liabilities from $287 billion to $219 billion. Equity has changed from $75 billion to $33 billion, while debt has gone from $136 billion to $79 billion. We can see that since the end of 2019, they've managed to reduce their liabilities while increasing the equity. What that means is they're satisfying liabilities faster than they're losing assets, and this is a good sign. GE basically has 5 major segments of their business: aviation, healthcare, power, renewable energy, and capital. If we look at the revenue growth, we can see that healthcare, renewable energy, and capital are all totally flat growth right now. Power has been losing a lot of revenue, and aviation is the only serious grower. When we look at each segment's profit, it's pretty clear that the only winners have been aviation and healthcare, but aviation is the only growing segment. Now keep in mind that all of these numbers are through 2019. Right now we're in the middle of the fourth quarter for 2020, so we don't have the full 2020 year numbers. But we can take a look at the last quarter of 2019 and add it to the 2020 numbers so far for a full year worth of data. This is called the trailing 12 months. The 2020 revenue numbers show just how much of a hit they've taken in aviation, but relatively speaking, the rest of their segments have lost some revenue, but nowhere near as dramatic as aviation. When we switch to the profit by segment view, we can see a pretty similar similar picture. Clearly, aviation is where they felt the most pain during COVID. I think for them to really grow, they're going to need to see the renewable energy sector take off by a lot more. It's very obvious that eventually renewable energy will be the way of the future and oil and gas will go away. So I would like to see them start to make real progress in their renewable sector, but so far I haven't quite seen that yet. Okay, so let's take a look at my valuation for GE and figure out if now is a good time to buy their stock. But before I do that, if you could just take a couple seconds to scroll down and hit the thumbs up button, I would be really appreciative of that. I put a lot of effort into making sure that these videos give a clear understanding of the business without getting too confusing, and if you could help me out with a quick thumbs up, I would really appreciate it. Going by the net income and earnings per share, GE has basically not been profitable for a full year since 2016. Even though we could see they had positive profits from the business segments, they took losses from interest expenses, taxes, and goodwill impairments. If you've never heard of a goodwill impairment, it's basically when a business has considered something that isn't physical as an asset. Usually these are things like the value of their brand name, reputation, or intellectual property. When it's determined that these goodwill assets aren't worth as much anymore, it gets subtracted from the business's earnings you see before the net income. For GE, right now, it appears that they're at least going sideways. So I'm going to use a growth rate of 0%. This comes out to a fair PE value of 9. So if we take a look at their trailing earnings per share, they ended up making 35 cents. That gives them a fair value of $3.15 per share. This is about 70% below the current share price. Now, if we take a look at the analyst earnings forecast for 2021, they only add a penny to the trailing earnings per share, bringing them up to 36 cents. The forward valuation increases to $3.24, so not much better than the trailing earnings. If we divide the current share price by $10.50 by the fair PE value to determine the earnings per share they need to make to justify today's price, that comes out to $1.16 per share. That's a pretty long way away from the current earnings and would represent about $12 to $15 billion in net income. What's difficult with GE is we seem to be right at the beginning of the recovery under Larry Culp, assuming that it does recover. It's very hard to say how long it will take for them to return to being a consistently profitable business, especially since we haven't seen that since the Jack Welch era, which ended in 2001. At this point, GE isn't something I would be interested in buying. While I like the new direction of Larry Culp to focus the business and decrease the debt, and that they've made significant progress, at this point we're still a long way from transforming the core businesses into the type of growth and profitability that I would be interested in owning. If you want to try doing your own valuation based off of a different growth rate, check out the PE calculator I have in the description below. Whenever I do a new valuation, I update that company to the sheet so that you can see the most current information as it changes over time. Now, if you found this video helpful, feel free to subscribe and hit the bell notification so you know whenever I upload a new video. And as always, thanks for watching.